Where are you based, Paul?
London.
Oh, lovely.
You're out in what? In Australia? Whereabouts in Australia?
Sydney.
Sydney. Lovely, lovely, a lovely city as well.
Yeah, it's good. You've obviously been here.
Yeah, a few times. Yeah, really like Sydney. Yeah.
I've never been to Sydney. I've been to Melbourne, Perth, never Sydney. Flown over it. It looks gorgeous.
Yeah, it's not bad.
Well, there it is on the slide. We had asked the question a few weeks ago, would an oil price war, a market share war be on the horizon? And by a small majority was no. But it turns out, or at least it appears that it might be. Welcome to the Daily Energy Markets podcast. It is the 27th of September, and we have Brent crude oil trading essentially flat this morning after a big shock yesterday. Saw it drop a few dollars, a few percent, mainly on the back of a Financial Times report that cited people close to the thinking of Saudi Arabia telling us that Saudi Arabia was going to open the taps and take on a market share battle. And although there were some murmurs by some reporting later in the day, I saw an Argus story sort of poo-pooing the FT story. But ultimately, something this big that the FT carries on their front page all day, if the Saudi oil minister doesn't come out himself and knock it back, or any Saudi official, senior official on the record has not come out and knocked it back, I think it has to still stand, from my experience of the business, as being fairly close to the mark. Let's welcome Rad Al-Qadiri back to the table, who's been at the table for as long as I have, would say, the metaphorical oil markets table. Dr. Rad Al-Qadiri, non-resident fellow at the Center for Strategic and International Studies. Your thoughts on the sort of news of 24 hours, but also taking it from the perspective, Rad, as to whether indeed OPEC Plus has any choice but to trigger a market share battle, because oil producers not bound by the supply cuts are now adding more new production than actual annual demand growth. In a world when China has stopped growing in its oil demand, or incrementally growing by very small amounts, this is a kind of an inevitable outcome. Your thoughts?
Good morning, Sean. I'm not sure that it's inevitable, but it's clearly an option that the Saudis have and OPEC has engaged in before. And it remains an option there. So I agree with you completely. I think sort of the lack of response from Riyadh over the last 24 hours, and knowing the business, you have to take those comments seriously. The question really is this a trial balloon and a warning to OPEC states, particularly the likes of Kazakhstan and especially Iraq, who are seen as increasingly sort of busting their quota, and as a result undermining this short-term market share strategy? Or is it something, as you say, and that the Saudis have to do given the state of the oil markets? The question really goes back to politics and sort of how long the Saudis think an oil war would have, market share war would have to sort of last for. Because there's a logic to a political economy logic to what the Saudis have been doing over the past sort of few years, which has been very short-term market management coming out of the shock of COVID. And that has been to sort of make sure that prices are strong, to maximize the monetization of their resources in order to fund what is a very, very ambitious economic reform and economic development program. The Saudis clearly can dip into reserves, they can dip into debt markets, they can sell off more of Aramco if they choose. But the reality is that's going to be a very costly way of pursuing a project that is already sort of facing fiscal strictures. And to have an oil price war, you'd have to sort of be sure that the additional barrels add up to the revenue lost even at $70 a barrel. So I think the jury's still out, but it's quite clear, and you and I have lived through this several times. If Saudi Arabia feels that the rest of its colleagues in OPEC Plus are not cooperating and are taking advantage of it, they will wield a stick.
Paul Hicken, editor-in-chief at Petroleum Economist. Not that I would often invite people into my bedroom, but ultimately there can't be too many couples that go to bed at night arguing the difference between the OPEC strategy. But I had that last night, and that was, where's the news here? There's no news here, says my wife. OPEC have already told us for months that they're going to increase supply by incremental amounts and by every detail. Where's the news? So I put that to you as I struggle to answer her. Where's the news here? News is something new. There's nothing new here.
Well, I think there is new. I think it is new. I would actually side with you, Sean, and actually bring some family dynamics of my own into it, which is, basically, I know what it's like. I know what it's like for the Saudis. You tell your kids something, they don't comply. You tell your kids again, they don't comply. And at some point, you've got to use the threat. No iPad. Otherwise, and even if it's going to cost me, I can't have some downtime because the kids aren't going to be on their iPad. They've got to use it. You've got to use that threat sometime to get them in line. And this is what Saudi are doing. They've got to use this weapon. The weapon's out there. To really get those cheaters, what you saw as cheaters or non-compliers, in line. And in a sense, I would say, as while it's a credible threat of a market share war, you could also see that if the market believes the threat and they see that other OPEC members see the threat as credible, that actually it's bullish, that actually the OPEC members will start doing more, maybe not completely come in line with quotas, but will start doing more to get on board, because nobody wants a market share war. And if they think their Saudi threat is credible, you might see more compliance, and it might start to see a more galvanized group, especially going into potentially the December meeting, where you may need to extend the cuts, where you may need to even go a bit deeper. And to that to happen, you need that compliance. So especially if you're thinking like the Saudis may be thinking, and OPEC, that actually will the US Federal Reserve measures be working? Will the China stimulus package be working? Are we in for a 2025 of potentially still a US recession or a hard landing, struggling with inflation? Is the China property issues going to be unresolved and continue into 2025? That means that OPEC Plus, if it's going to work, it's got to be in for the long haul. You've got to get the cheaters in line to some degree. I think Iraq, there will always be some wiggle room for Iraq. They've been non-compliant since 2016. There's been problems with Iraq, and to some degree, I think there's a little bit of empathy for Iraq given their whole history, which we know, and with their oil production, their oil industry. But there's that empathy only goes so far, and getting that in line for 2025, I think this is all a ploy to trying to get ducks in a row for December meeting early on, because they need that compliance if they're going to extend the cuts.
Peter McGuire, CEO of XM Australia. Peter, your thoughts on this debate, and particularly where do you think it impacts the financial investors? We saw in early September during the APEC week in Singapore that net shorts outpaced the long for the first time ever. How does something like this attract the financial funds back into the oil markets, or does it scare them away? Your thoughts on the impact for the market dynamics and the price of oil?
Well, Sean, I mean, when you're looking at, and welcome, and nice to say hi to everyone from Sydney. Brent's sitting at 71 3/4. You got 67.80 for November WTI. It's very, very choppy, as you know. And I mean, it's just been extraordinary. Yeah, the US dollar come under pressure. We're not sure as far as what we're doing as far as rate cuts in the sense of the size of them leading up to the end of the year for the US. There seems to be a continual drag down from everyone saying we're cutting. ECB, Swiss did yesterday, 25 basis points. So as we're seeing all of this work through the market, Sean, while you've got, and you said net shorts there, there seems to be plenty of opportunity for retail traders anyway to trade the market. That's the beauty of it, because it's so wild and you've got these big swings, which are very attractive. So I don't think the focus has gone off from a trading perspective. Where do we see a bottom out? I wouldn't have thought this time in the last few days you'd be sitting here sub 68. I thought you might have WTI, the best part of 72, 73, but that hasn't been the case. So there's plenty of the big hedge funds and everyone's just moving the market as much as they can to see opportunity. Where does it move from here? I wouldn't be surprised, maybe another $1 or $2 drifted out of it, and then it'll bounce and it'll go back up. And I think just repeat the same old series that we've seen over the last couple of months. There's plenty of money to be made in other markets at the moment as well.
But you don't, Peter, you don't think that, I mean, this FT reporting, which is indicating, you know, a sort of a drowning of the market going forward, drowning or certainly opening the taps or whatever metaphor you want to use, ultimately more oil than the market wants, that obviously the price dropped off yesterday. Is that it? I mean, does this market lose more on the ground? I mean, Libya is due to bring back 500,000 barrels now that they've done a deal.
Well, exactly, Sean. So that's why I'm thinking it's got a couple of more bucks to be stripped out of it. And, you know, let's see where it is at 64.5, 65. If it's there, it might snap through that. I mean, there are so many variables that go into seeing where price discovery is going to be. But at the moment, we're certainly in a downdraft with extra barrels coming online and the likes of Saudi coming out. It'll be a fascinating end of quarter because we're only 40 odd days from the Trump / Kamala Harris election. If she is the presidential candidate, we still don't know that really, but I would assume it is.
But she's still the candidate, but whether she wins or not, we will see.
And the impact that has, naturally, if President Trump's saying he's going to drill, baby, drill, then what impact is that going to have to price as well?
Well, I mean, we have a hard time to convince ExxonMobil to drill, baby, drill if it's going to knock some dollars off the barrel. Brad, just coming back, I mean, you and Paul sort of immediately indicated in your commentary that an announcement like yesterday was principally targeted at the other members of the OPEC Plus agreement who are not complying, most notably Iraq and Kazakhstan. But my thoughts are more about where does my question about it not being the choice, the ability to sustain these level of cuts when you've got obviously Libya outside the agreement and they got removed from the market. Now it looks like they're going to come back with 500,000 barrels of increase in the coming months. You know, Iran outside the market pumping as much as they can. You know, Guyana, all of these countries adding all of these barrels. With China plateauing and certainly at least not growing anywhere remotely near where it was, this is this not targeted at the more high cost producers rather than get the OPEC Plus in line? How, I mean, the drill sort of address the question of how sustainable these levels or cuts are in a geopolitical environment where clearly countries are looking outside of their group and saying, why can they all pump as much as they want and we can't?
I mean, and I think in many ways, I think you're asking this or asking the same question in a different fashion to what Paul and I were saying. Like, there's always geopolitics in OPEC. There's always been a tension in there. I mean, at the end of the day, these are sovereign states making voluntary decisions in an organization that isn't binding. So, you know, there's always that aspect of it. And you're absolutely right. As you've looked at softer markets, as you've taken the outlook for 2025 that's there, which is sort of a level of growth of 1 million barrels a day or maybe a little more, and you take the non-OPEC production that's there. And yes, then the Saudis and OPEC in general faces the prospect of declining market share, or certainly not being able to take advantage of that growth for quite a period to come. It's going to be eaten up by others. So, but I do think those are slightly two different dynamics: the internal OPEC and the external OPEC. The external OPEC is a challenge that's, you know, that is there.
But in the past, that's where oil price wars and market share wars have been targeted. They've been targeted outside OPEC rather than inside.
I think, Sean, you and I go back sort of long enough to know that it's both. I mean, I can remember
Both.
the Saudis threatening to wield a big stick for OPEC discipline sort of several times when Ali Naimi was Saudi
Yeah.
oil
A
minister.
big one against Venezuela.
Exactly. So I think, I do think it works both ways, but it goes back to that fundamental question that you're asking. How much are the Saudis and OPEC willing to see their market share erode to keep prices at present level or above? So are you going to see a fundamental shift, not just in market management strategy, but very short-term market management strategy, which has been a different aspect of OPEC since COVID? And they've intervened much more regularly and much more aggressively to keep the price up. There's a political logic, there's a fiscal logic for that. But I do think we are at a point, and I agree with Paul. I think we're at a point where there's a message that has to be sent, and I'm not sure that Iraq, sort of in particular, is necessarily going to comply just on the back of nice questions and nice requests and visits by the OPEC Secretary General. I think the problem with this is if everybody calls the bluff of the Saudis on this one. And that's where to follow on with the kid analogy, the moment your bluff is called, then you either sort of implement the punishment or not. So I do think we're in for a really choppy period of time. But the manner in which it was suggested, the sort of message to the market, which is one that was only going to dampen prices, certainly in the short term, is, I think, also a message that we the Saudis will consider other options. And if you guys don't come along with that, particularly in the type of market that you're describing, a soft market, then sort of we are going to prioritize our own interests. We're not necessarily going to sort of continually take and carry the burden for the rest of the OPEC organization.
Paul, this cycle of current cuts and tight market management started in March, April 2020, when famously at the beginning of COVID, but famously before COVID really sort of presented itself, Saudi and Russia had a sort of face-off around finding alignment on managing supply. Where do you put Russia these days in that? That they obviously sorted it out then and had a massive cooperation for a number of years, but where does that look like now? Russia very capably exporting all of its oil, coming very strongly and now would appear permanently into Asian markets, the sort of main market of the Gulf producers. Where do you think that relationship is now, and Russia complying with all of these agreements?
It's a great question, Sean. I think Russia is one of the big ones that aren't complying as well as probably Saudi would like as well, and they are the ones with probably a lot to lose in a sense. If we went into a market share war at this point. At the same time, I wanted to address, and I think what Brad was saying is, it's. This threat is credible. We've seen, Russia knows that threat's credible as well. I mean, we saw negative prices back then, in the US at least for various reasons, but at least record low in Brent. So it is a credible threat, and it quickly got people back to the table very quickly. How long did it last? Well, we saw last time, it doesn't last very long because nobody really wants it. And to address your point, you raised about non-OPEC supply and being, what does that mean in the mix of things? Well, that's always the outcome of when you try to
but always is different
prices.
Now. That's my point. The always is changed in the sense that China is now plateauing into a traditional OECD economy on, they're saying 5% GDP growth, but that's like, beating the bushes as hard as you can. It's going to essentially drift into the weeds of a normal OECD 2-3% growth. The party's over in China. Something has to change on the supply side.
Well, in a sense, yes, but you're right. But at the same time, what does Saudi? We've said it before. OPEC and Saudi are kind of boxed into a corner. But at the same time, what do they do about it? You can only do two things. Either you flood the market with crude, and that's damaging for everyone, unless you're going back to a very big cycles of boom and bust prices, or you try to find a new equilibrium. And maybe the reality is dawning that potentially 60 to 70 is a new normal for what they would have to accept. And while a lot have been made about what Saudi needs fiscally, I think that's often overplayed, often exaggerated. When you saw the FT article, I thought the idea of an unofficial $100 price, I mean, seems ludicrous. Where did that come from? I mean, that sounds like it came out of 2 years ago of an idea. I mean, who's really
something squeezed into a headline? I think it seemed.
Yeah, I think maybe there was, unofficial. I mean, that's just a word we use for. But I think we've more been talking about a floor of $70 or $80 a barrel rather than actually a target. I mean, even though they would not say even officially or unofficially, they wouldn't target price, but I think even unofficially, targeting $100.
That kind of weakened the story for me. When I saw
did.
that, it sort of felt like, oh, this seems sort of
didn't feel like didn't question their sources enough or provide enough context to the sources, not to call out the FT too much, but yeah, I felt that needed a bit of context around sort of unofficial $100. We haven't seen that apart from a spike when the Russia crisis happened. So yeah. I don't think in even the heyday before we talked about economic weakness, we were talking about 80, 90, 95 at best. So yeah.
Peter, the other big news this week that, again, alongside of, as you listed off there, all of the monetary easing that's going on around the world and in a sense only beginning, but we've and that also included China this week. And we've seen China's stocks are heading for their best week since 2008. I mean, that's like a long time ago now, even though the financial crisis still feels very present in the trauma that it left. But ultimately, China, where's China at? Where's this stimulus? Is it going to, is that the defibrillator bringing the beast back to life? Your thoughts?
Well, I don't know whether it's bringing it back to life, but if you let's look at as far as the performance, Sean, it's been extraordinary. You've got the Chinex index up the best part of 22.5 for the month. That's percent. And you've got the CSI 300, and we always throw that one around. That's nearly up 12% for the month and 4% today. So it's been extraordinary. The market, I think everyone's buying into the storyline. You can't say it's not happening. You've got very strong numbers across Hong Kong as well. So the overall momentum has got to say that it's been a successful initiative by the Chinese government, the bank, to try and stimulate positive sentiment. So there's the first part. The second, so everyone's bought into the story. The second part, how long it's going to take. You were saying as far as that 5% GDP target, is that going to be watered down? Is it going to be achievable? We've just got to wait and see. And naturally, you've got a property, we say it nearly every time we're on together, the property overhang is something that the government needs to really address and really address it quickly. And is this going to be enough of a panacea to stabilise the property sector? Only time can tell, Sean. But, you can't argue with the numbers when you're, at these sort of levels since 2008. It's really quite extraordinary.
Let's go to the survey question, which, of course, addresses this main point this morning. The OPEC Plus has no choice but to trigger market share battle because oil producers not bound by supply cuts are adding more new production than annual demand growth. Not that I'm saying that is my point of view, but ultimately that's my question. As my wife then said to me last night, what are you talking about? They announced 6 months ago they were going to increase supply by 2 million barrels over the course of the next year. Where's the news? Anyway, this is, let's take it, going to be an open the taps kind of reporting from the FT yesterday rather than just following through with what they've already said. Rad, sort of detouring, but certainly also a pillar in this market is geopolitics. We are back to a kind of an elevated noise and explosions, obviously, in the context of Lebanon. We have Netanyahu going into the UN meetings today. Your thoughts on how big a factor this is? The West does seem to be trying to get him under control in some way on this attack on Lebanon. What's your reading to it? Where's it going?
From a market perspective, I think you saw a slight bounce, sort of as Israel escalated its attacks on Lebanon sort of over the weekend. But yesterday's correction sort of gives you a sense of how skittish the market is on this. And I go back to a comment I've made before, which is that where the threat is how close this conflict gets directly to Iran, and as long as it's contained sort of away from Iran on the sort of East Med, then the impact on markets is going to be minimal. It adds a certain level of concern, but I don't think it's something that sort of radically
Well, speak to
changes
that
the price
point a little
trajectory.
bit. Speak to that a little bit more, because I think one thing that does appear to be emerging for the first time in a while in this current window is a gap between Hezbollah and Iran. There's always the narrative they are in lockstep, they are with the same thing, they are one. Hezbollah is a proxy, etc., etc. Your thoughts on some gap appearing between the two, or so because the outcome of this could, that could determine the outcome of this.
No, so look, I'm not sure there's a gap, and I think this notion of Hezbollah is an organization sort of managed by leaders in Tehran pulling strings has always been sort of simplistic. I mean, Hezbollah has its own raison d'etre. It emerged with its own raison d'etre, and that was to try and get Israel out of Lebanon the last time it invaded. So I think that difference in terms of strategy, I think where you've seen really remarkable restraint from Hezbollah at this moment in time, as they've watched their assets being degraded, as they've watched their leadership coming out. And I think that may reflect caution on the Iranian side, that they don't want to see a full-blown war, and they don't want to invite what is clearly a determined Israel to neutralize Hezbollah or degrade Hezbollah more significantly. I think your point about Netanyahu is probably the key one in terms of this. Netanyahu has been minimally restrained by the US and everyone else sort of since this crisis kicked off. And has pushed red lines and pushed lines continually. I mean, it's almost like a frog in a saucepan type of strategy. And for Netanyahu, it appears to be working. So the notion that, I think the sort of way that the Israelis, or the way that Netanyahu has handled the ceasefire proposals over the last 48 hours are a good indication of that. It's say I will talk, and in the meantime, continue to sort of take out targets and continue aggressive strikes. It's the same strategy that was used in Gaza. It's the same strategy to a certain extent that's being used in the West Bank. The Israelis started off this conflict in response to the October 7th attacks, sort of laying out very clearly that Gaza was one part of a strategy to restore deterrence and restore Israel's security, and that Hezbollah and undermining Iranian strength were key aspects of that. And I think they've been following that strategy assiduously, maybe slower than we might have imagined at the start, but I don't see anything that's there that's significantly going to restrain Netanyahu and the Israeli sort of government more generally as it seeks to achieve those wider objectives.
Paul, just to wrap up your thoughts on, the earlier story in the week, the OPEC report looking at really massive demand growth over the medium and long term, its relevance to the market in a year in which OPEC are still sort of projecting a 2 million barrel a day demand growth, when it's very clearly now, and most others are saying, are one. What weight do you put into those classic reporting formats, the IEA, the OPEC, the global inventories? They all seem to be somewhat irrelevant or marginalized as indicators for markets at the moment.
Well, yeah, because I think there's a growing sense that these reports are being ideologically driven. I think we've never seen so much time where the splits feel more ideological than actually based in sort of. Well, I know long-term forecasts are always, how do you really, they're always way out of sync to what they really become to. But at the same time, there's always kind of an idea of economic planning, long-term planning, And it feels at these point, these long-term forecasts are very ideologically driven. And how credible the arguments from both are credible, we don't know. Technology and policy are huge in terms of how these shifts are going to happen. But I just wanted to, before we close, I just wanted to address one last point, which is actually we haven't talked about we haven't talked about risk premium again, and in the market with geopolitics happening. And it's interesting because normally when this happens, geopolitical risk premium is right up there. We talk about 5-10%, and while these are often arbitrary numbers, because if actually something really went bad in the Middle East, if this terrible situation spirals out of control, you're talking way over $100 a barrel oil. But at the same time, that's still a very low level case at the moment. And it's interesting that market hasn't really reacted to that we are in such a bearish trend. And what's surprising in the sense that we're in this bearish trend is that actually balances are actually tightening all the time. And yet the market doesn't seem to be reacting to that. We talk about demand being weaker. Yes, it is. And we talk about supply holding up well. Yes, but there's still actually, despite the weakness of demand, despite the strength of supply, there is still a balancing going on, and the market hasn't seemed to react to that. And it'll be interesting over the next few weeks and maybe a couple of months going to that OPEC meeting, how those balances and how OPEC and Saudis react to that as well. And I think that's something to keep an eye on.
Peter, last word for you. I wanted to get so there's a disagreement in this room to my thesis. Peter, I wanted to get your thoughts because I'm trying to, as you put the pieces together, what does gold keep hitting records for or mean to you at a time when we've seen that we're in a monetary easing cycle? Inflation is supposedly locked away in a box now. Why is gold keep meeting new heights and not stopping? 2006 or something at the moment?
Well, Sean, 1800 start of October last year, I think it was 1807, and now you're sitting at 2700. Anyone doing the math, it's nearly 50%. There is obviously a level of fear. You've had incredible central bank buying over the last decade or more, and certainly been heightened up as far as aggressively over the last 3 to 4 years, the likes of India, Russia, China, you name it, Turkey. So there's the first part. Second part is, Sean, you've got the paper market and the physical. There's huge attraction, the paper market as far as retail traders, and the store of wealth as far as retail, and every man and his dog is buying gold and putting it under the bed. So record sales from jewelry production and everyone buying bars. So there's that. I think there's a lot of fear in the market with a fully priced equity market. If it does take a dip and if it does wash out, there's a place to be. I think the inflation story frightened everyone, and I don't necessarily think it's over, and I'm not sure because it is cumulative, and we've got to be conscious of what the cost of goods are where they were 3 or 4 years ago. And I think that there is a degree of it was probably held underwater to some extent, and it's really starting to rage ahead aggressively. So the storyline is, Sean, it's onward and upward. Many people are saying 3,000 by end of year, and the rapid aggressive move from 26 to 2,700 has been literally done in about a week and a half.
Well, I don't think we've ever seen, or I can't remember, when the Fed has cut 50 basis points, when the US economy has been enjoying full employment and inflation is still above target. It's no wonder gold is going up, because I think there is a third corridor now in which the Fed is managing, although it's not its mandate, and that's the US government's ability to pay its debts, and that's becoming a factor. Anyway, yes. All of these things, you could talk all day. Rad Al-Qadiri in the United States. Really look forward to hearing how all that's going to go over the next month. Paul Hicken in the UK and Peter Maguire in Australia, literally all around the world. And we're going to be taking the next week off because we have a massive annual Energy Markets Forum in Fujairah next week, our annual gathering, which is looking like it'll be a great few days. And Paul is coming. I know that. We're delighted that he is. Peter, unfortunately, I don't think is making it this year, or Rad, so we'll miss you guys. So we'll be deep in all of that stuff. and the content will flow from it accordingly. Thanks, guys. Have a great weekend and see you all soon again. All the best. Bye-bye.
Take care. Good luck
Sean.
next week.
Thanks, guys.
Cheers, mate. See you, Paul.
Cheers. Bye.